This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. President Trump follows through on his tariff threats, sending the S&P 500 to its worst losses of the year and boosting bonds. Confidence further eroded by weak U.S. factory and spending numbers. The president signing an order to double China tariffs to 20% and telling Canada and Mexico there's no room left for negotiation before Tuesday's deadline.
And I'm Stephen Engel in Beijing, where China's top leadership is set to begin key political meetings here today to map out its latest economic revival plan, seeking to ease, of course, the impact of Trump's trade war.
And of course, one economy that is very externally exposed when it comes to some of these global trade tensions is South Korea. We are getting the latest data when it comes to industrial output, factory output just crossing the Bloomberg. Industrial production year on year for the month of January contracting a much worse than expected 4.1%. The expected consensus was around a 2% contraction, so worse than that with 4.1%. The prior reading was a gain in December of 5.3%. On a seasonally adjusted month-on-month basis, we're seeing for January a contraction of 2.3%. That's a little bit better than the expectation of a 3.1% fall. And of course, Shery, we continue to wait for kind of the implications when it comes to an economy like South Korea. Bloomberg Economics saying just the mere threat of tariffs could cut 0.8% off that 2025 GDP number.
And those tariffs really to take effect this week. We have seen already the implications for the U.S. markets. Take a look at futures pointing slightly to the upside after the worst sell-off of the year. We saw the VIX spiking to the highest level since December, breaking out of its recent range. We had oil prices also sinking to the lowest this year, right now holding at that $68 a barrel level. Of course, we had that surprise move by OPEC announcing more production to come starting April. We have also seen treasuries rallying, this to do with really haven demand, of course. Take a look at how the Japanese yen is also doing, because we saw gain ground overnight. We have seen the Japanese yen pretty strong in recent weeks, given, of course, the BOJ's tightening path. We will be watching for jobs data today, not to mention capex and company profit data out of Japan this hour as well. But take a look at the Chinese yuan. Of course, we have the NPC kicking off this week at that 730 level, as President Trump has also doubled its tariffs on China, signing that order to 20%. And interestingly, President Trump also talking about how the Chinese yuan and the Japanese yen were weak, and that weakening trend really causes a disadvantage for the U.S. Could that be the next front where the battle in trade, in commerce is fought? We'll continue to watch, as we're seeing the Nikkei futures right now under a little bit of pressure at the moment as well, Heidi.
Yeah, let's talk more about our top story, because as we mentioned at the top, President Trump saying there's no room left for Canada, for Mexico to negotiate a deal to avoid these 25% tariffs due to take effect in the coming hours. Take a listen.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect tomorrow?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
Well, Canada says it's already prepared a package of counter tariffs against U.S.-made products, while Mexico's president has signaled that she will wait and see what happens. Let's bring our global economy correspondent Enda Karen. And there's a lot of concern now at this point that, the markets have woken up to the real threat of potentially now the kicking off of a trade war.
Yeah, it does seem as though these tariffs on Mexico and Canada of 25% are set to go into effect. Heidi, that's what the president said today in the press conference. There will, of course, be some of a carve-out for Canadian energy. That will be tariffed at 10%. But you're talking across the board goods from both trading partners coming to the US. That's on the one hand food and fresh produce and clothing apparel. On the other hand, it's industrial goods, it's cars, like you mentioned, and it's going to impact the supply chains between both Mexico, Canada and the US. Now, of course, the other point is we have confirmation from the president that he will go ahead and double the tariffs on all Chinese goods from 10% to 20%. That will also be going into effect. Important to note there, that's not just on intermediate goods or national security related products or anything like that. It's across the board blanket 20% tariff on all Chinese goods coming to the US now. So all told, about 1.5 billion worth of imports will be impacted by these tariffs should they all go into effect as of midnight tonight.
Yeah, and the fact is that these are not the first tariffs that could take place, right? I mean, we are talking about potentially aluminum and steel tariffs also coming up, lumber being investigated, not to mention reciprocal tariffs as well. So what are the implications broadly for the U.S. economy and the global trade environment if they do, in fact, take effect?
You're right, this is only one step in the sequence of tariffs. I mean, these tariffs against China, Canada and Mexico are on paper against fentanyl imports and, of course, against illegal immigration. We move on to March 12th. We'll get new tariffs on steel and aluminium coming into the US. We move on then to the beginning of April. We're meant to get a lot of reports back from the Trade Representative Office to the White House suggesting how they will impose reciprocal tariffs on trading partners around the world and sectoral tariffs on goods like pharmaceuticals and autos, for example. And, of course, President Trump, as you mentioned, has spoken about lumber and agricultural produce. So the point being, all of this is starting to add up now. We're seeing it in the sentiment indicators. We're seeing it in the inflation expectations. We know that industry and small manufacturers in particular are crying out about the costs imposed on them. Now, on the flip side, the administration says this is important to drive investment in manufacturing in the US. They touted the announcement from TSMC today as one example. And, of course, it will help raise revenue for the government too. So very split views on all of this, but there's no doubt that right here, right now, economists are saying there is some downward pressure on the economy as a result of these rolling tariff announcements.
Bloomberg global economy correspondent and current there, and Trump's doubling of tariffs on China also coming as the country's top political advisory board begins its week-long gathering in Beijing. Bloomberg's chief North Asia correspondent Stephen Engel joins us now live from outside Beijing's Forbidden City. Steve, what can we expect?
Well, of course, this is the annual session of Parliament. It's the two meetings, Liang Hui, as it's known colloquially here. It is today the beginning of the CPPCC, which is a mouthful on a very cold morning here. It's the Chinese People's Political Consultative Conference. It brings together nearly 3,000 different delegates from all different parts of society. Communist Party members and non-Communist Party members. They'll come to Tiananmen Square and the Great Hall of the People this afternoon with various proposals to the Chinese government. Of course, the NPC, which begins tomorrow. That's the National People's Congress, the annual session of Parliament. It's a lot of talk today at the CPPCC. Tomorrow is where the action happens, and that's where Li Qiang, the premier, will give his annual work report. Last year, it lasted a little bit over an hour. That's what we're expecting again. But as we've talked to a number of guests, we're expecting this National People's Congress to be quite consequential, given the stresses, as you're seeing here on the screen, facing the Chinese economy, and complicated, no doubt, by the looming trade war, or not the looming, the escalating trade war in the Trump second term, obviously, with him signing, again, the intention to raise tariffs, doubling them from 10% to 20%. That adds stress to what has been an economic recovery that has been stumbling, but backed by strong exports. Obviously, the Chinese government has been dealing with a prolonged property crisis, a prolonged slump in consumer confidence, and also there's a bit of a rebound, of course, in sentiment towards tech and AI, fueled by optimism over DeepSeek and some of the efforts by the Chinese government, no doubt, to boost domestic innovation. However, that leads to another concern. Will there be enough stimulus announced tomorrow? Will there be some confidence that there's momentum and that they can then dial back that stimulus? So we'll have to see, again, from that work report, where we're expecting, most economists surveyed by Bloomberg expect another target of around 5% GDP growth, and then raising the budget deficit to the highest in several decades.
Steve, given these ongoing domestic challenges, what tools do Beijing have, right? What are we hearing that potentially a counter-response, tariffs or non-tariff measures might look like?
Yeah, that's right. So we had column yesterday in the Global Times, essentially the mouthpiece of the Communist Party, which is often used, no doubt, to sort of convey leadership sentiment, since we don't get direct word from them, through press conferences and the like. Again, last year, Li Qiang, the premier, usually gives a press conference at the end of the NPC. Last year, Li Qiang's first as premier at the National People's Congress, there was no press conference. So we get this, reading the tea leaves to excuse the overused, cliche. But the Global Times saying that there could be retaliatory steps if indeed these additional tariffs do take place. And this time, because remember back in, about February 10th, when we got that first 10% tariff across the board on Chinese exports to the United States, China had a fairly muted response. They essentially put some tariffs on about 80 different products, but not agriculture, not food, like they did in the first Trump administration trade war, where soybeans were targeted and other agricultural products. They also did some export controls on tungsten-related minerals. They added 2 American companies to the entity list. They pledged to take this case to the WTO. This time they can hit America a little bit harder, and that is attack soybeans and others with tariffs. Last time around, my last point here is over 2 years after China put those tariffs on American soybean imports to China, soybean exports to China dropped by about 80%.
Our Chief North Asia correspondent there, Stephen Angle, this morning, just in front of the Forbidden City in Beijing. Let's bring in, for more market reaction, Bloomberg MLife strategist Mark Cranfield. And Mark, one of the sort of running sentiments from this overnight session is that these markets, investors that perhaps have been on the side of complacency until now, have truly woken up to this threat of a trade war.
Yeah, it's a bit of a jolt, isn't it? Anyone who thought that it may or may not come, or it might come a bit later, they've suddenly woken up to that. And markets have taken a very defensive approach. That's initially what you're seeing here. So quite a decent sell-off in US equities overnight, and a bid for treasuries. People are now pricing in 3 interest rate cuts quite clearly from the Federal Reserve this year, with the first one expected to be seen in June. So clearly it's a fluid situation, but traders' minds are very much going towards the fact that this overall is not good. But they're seeing that it's both coming from the US side, but they expect some responses, whether it's from Canada or China or anybody else. People are not taking this as a one-way street, and that means that the trade war that Stephen was talking about is fully open now. If there was any doubt about it, we're into a full-scale trade war, and that's how investors are behaving. So you're seeing some of the currencies like Canadian dollar, the yuan are getting a bit weaker, but the bid for treasuries is the typical haven move. The yen is also stronger overnight as well. That's where you would expect people to go very quickly when they're the most defensive, when they're most scared about what's coming down the line from governments around the world. US treasuries have proved themselves to be a very good haven. Now, what's very interesting here is that during Mr. Trump's first administration, he was quite concerned about the health of the US stock market. So far, he hasn't spoken much about what the S&P 500 is doing, and clearly the initial response is that people think it's going to be bad for US equities as well as for other parts of the world. That's quite a change. He has talked about wanting to see lower yields, which he's certainly getting as a result of this. So let's see where it goes. There may well be a pain threshold. Investors will be watching out to see if there's any change of direction from the White House once US equities have fallen far enough.
And Mark, I mentioned this earlier, but President Trump continues to mention Japan and China, putting the U.S. at an unfair disadvantage when they weaken their currencies. Of course, that's not necessarily that these countries are doing that. It's just the market fundamentals and the rate differentials and everything else that's happening around tariffs as well. But could this be the new front where the battle is fought, an FX, a currency war? And what would that mean for the markets?
Well, we certainly would expect the Japanese authorities especially to take this reasonably seriously. And we have a speaker this week, Bank of Japan's Uchida is speaking, and you would expect him to sound fairly hawkish. The Bank of Japan is moving towards higher interest rates. They've raised already once this year. People at the moment don't expect them to do it again until about the third quarter of the year. It's likely they'll try and steer that to a nearer timetable. We may well get Mr. Uchida speaking and saying that Japan wage rises have gone up enough, the data is supportive, inflation is high enough, they may well start to channel people to thinking an interest rate hike in Japan is coming fairly quickly, possibly even as early as April or May. That is certainly a possibility from his speech this year, maybe not this month. That will feed into the yen. You can expect the Japanese authorities to allow the yen to gradually get a bit stronger. China is in quite a different situation. As you were saying earlier, exports are such a big thing. We can't expect the yuan to weaken, to get stronger very quickly. It's probably going to stay relatively weak to other currencies.
Bloomberg's Mark Cranfield there. Coming up on the Asia trade, our analysis of Trump's tariff policy continues with former trade negotiator Wendy Cutler. M&G Investments explains why they remain constructive on Asia's three largest markets. Plus, we discuss investment opportunities for Australia's pension industry with the CEO of Colonial for State Superannuation. This is Bloomberg. President Trump says he's moving ahead with new tariffs on Canada and Mexico, a broadside against the two biggest U.S. trading partners that underscores his push to remake global trade. Canada says they're preparing a sweeping package of counter tariffs against U.S.-made products, while Mexico is taking a wait-and-see approach before reacting. Let's bring in Wendy Cutler, Vice President at the Asia Society Policy Institute. She previously served as the acting deputy at the U.S. Trade Representative. Wendy, always great to have you with us. Digest the latest measures for us, because, of course, we have a series of potential tariffs coming up, steel and aluminum, reciprocal lumber. But also we could see reciprocal tariffs as well coming, or retaliatory tariffs coming from the partners as well.
Absolutely. I think based on the announcements today, we are on the cusp of a trade war. Remember, China and Canada and Mexico are our largest trading partners. We have a lot of two-way trade with these countries, and this can escalate very quickly, particularly if the countries retaliate against the United States. It's not clear that our president won't want to counter-retaliate like he did with China during his first term, resulting in a big trade war.
Are there any lessons that we could take from Trump 1.0 to this administration and perhaps even the fallout and consequence of all of these new tariffs?
I think one thing to keep in mind that the president does like to make deals. And frankly, I think there is a small chance that between now and midnight, some deal may be made with either Canada or Mexico, I think would be more likely. I'm not totally convinced those tariffs are going to go into effect. China, yes, because there are very few conversations going on, if any. But Canada and Mexico are making efforts to address his concerns.
Wendy, I do wonder when it comes to the possibility of obviously parties coming back to the table. We know that President Trump likes a deal, even though at this point he says the time has run out for negotiations before this next deadline. Does it matter in the sense that how much is broadly sentiment, confidence and predictability when it comes to decisions that businesses are making being impacted already?
Well, absolutely. And what's different this time is that even if you reach a deal with them, let's say Canada and Mexico do reach a deal on fentanyl and migration, next week they're going to be subject to steel and aluminum tariffs. And then in April, it may be reciprocal tariffs or sectoral tariffs. And so it seems that this is going to go on. And if you're a business wanting to invest, you want certainty. And the president is not providing that certainty.
You've said that Mexico is expected to be in a better position, Canada perhaps more rocky. China, though, Beijing has barely acknowledged the accusations when it comes to the fentanyl trade. So how much does that really kind of deter a possibility of negotiations?
Well, I think as of now, we should expect that additional 10% tariff to go into effect on China. And that's on top of the 10% tariff from just a few weeks ago, and that's on top of the 25% tariffs that were put in during the first term, as well as some Biden tariffs as well. So we're getting to an average tariff rate with China close to 40 or 50%. Americans are going to feel this in their pocketbook, particularly when tariffs are also put on Canada and Mexico as well.
Wendy, what does all of this mean for the USMCA? There was supposed to be a review coming up anyways.
So you're right. This review was scheduled for July of next year. And my view is it's de facto going to start much sooner. And frankly, there are a lot of issues we need to work through with Canada and Mexico, but I don't think we're going to wait until 2026 to do so. It's going to be a very rocky ride with Canada and Mexico. And let's keep in mind that until maybe tomorrow, we've had zero tariffs with Canada since the 80s and zero tariffs with Mexico since the 1990s. So, you know, as a result, this is going to be a shock to the system.
We've been speaking for years, Wendy, and of course in the past we're talking about the TPP, which also became the CPTPP. We've talked about the USMCA. What's the future of all of these multilateral trade agreements, especially in this environment under Trump 2.0?
Well, for the agreements we're not part of, I think those agreements are continuing to not only remain in place, but our trading partners are forging new trade agreements among themselves, as well as inviting additional countries to join the CPTPP or join RCEP. The United States is on the outside, so we are going to be further disadvantaged by those other countries enjoying free trade among themselves, and while we are putting up tariff barriers and not benefiting from tariff reductions of trade agreements.
You know, the times that we've spoken in the past, it's a pretty common adage that nobody benefits from less global trade, right? But do you think that there is a winner out of this? Who can potentially, if this is sort of a longer lasting positioning that the US is going to take, who potentially gains the most here?
Right now, it's hard for me to see any winners. It seems like lose, lose, lose. Now, that said, we do have trade laws that allow for the imposition of tariffs when certain conditions are met, like unfair trade practices. And so I fully support putting tariffs in, using those procedures to do so and doing the needed investigations. But this notion of every week threatening another country with tariffs really threatens the global economy. And frankly, even if we were to bring more manufacturing jobs home, the prices for the workers in these manufacturing plants of consumer goods and the stuff they need to just get by are going to, represent a heavy burden on the average American worker and the average American family, with estimates going as much as a loss of $2,000 per household just based on the tariffs announced that might go into effect this week.
Wendy, always great to chat with you, particularly at a time like this. Wendy Cutler, Vice President at the Asia Society Policy Institute. More ahead on the Asia trade. This is Bloomberg.
U.S. futures higher in the Asian trading session after we saw the worst sell-off of the year on Wall Street. The S&P 500, 5% below its record high. We had some weak eco data on housing and factory activity. This is Bloomberg. We have breaking news out of Japan. We are getting the jobless rate for the month of January coming in at 2.5%. The estimate was for 2.4%. So we're seeing a little bit of slackening in the labor market. But when you look at the job to applicant ratio, in fact, going to 1.26, which means 126 jobs offered for every 100 applicants, which is slightly higher than the previous month. Of course, this will have implications for the Bank of Japan and broadly for monetary policy here. So let's bring in Bloomberg senior Japan economist Taro Kimura here in the Tokyo studio with me. Taro, so what do you make of the numbers today?
Right, the figures still points to a very tight Japan's labor market. The ticking up of unemployment rate isn't a big concern, given that the statistics itself changes the sample every month. So therefore, some fluctuation happens. So there's no worries. And as you mentioned, Shery, the pickup of the job-to-applicant ratio is showing that the labor market is going to become tighter in the future. So therefore, it doesn't get in the way of Bank of Japan tightening further by increasing rates. How
is this really translating to wage growth?
Actually, the wage growth is bolstering Japan's wage growth. And last year, Japan made a significant, surprisingly solid wage growth. And I would call it for the first time in 30 years. And actually, the Shunto negotiation fed into macro data. That should be a very pleasing moment for the Bank of Japan, which strengthened its confidence that the CPI target will secure around 2%. So therefore, tight job market and also the business managers' willingness to increase wages in order to secure labor, that's going to bode well for this year's Shunto negotiation.
How much of a drag will continued weakness in the yen be?
Right, that's a difficult question because the BOJ's messaging is, although they continue keeping increasing rates, but they are very careful in sending messages, and sometimes their policy signals are sugar-coated with dovish words. And also, when it comes to the U.S. policy, initially we thought that's going to weakening the yen further because basically we thought the Trump's policy is strengthening the dollar. But given recent wishy-washy or the lower risk sentiments given the tariff woes, I think the swings on the yen can move in both sides, and the traders should be very careful on the messaging from both policy side.
Did you bring forth your BOJ rate hike expectations for the year? Because I think the consensus was for around the summer in July.
Right. I reckon the BOJ will move earlier because given the CPI data print and jobs data this morning or whatever, the GDP numbers very solid. All this indicates the things are going what the BOJ had planned when they ended the negative interest rate policy. So in my view, there's no reason for the Bank of Japan not to hike rates under the status quo. And my view is they will hike in the meeting on April 30 and May 1st, because when they update their official forecast and the CPI number is very solid, so there should be some upward revision to it. So it's harder for them to explain, rather harder for them to explain not to hike at that moment.
Bloomberg senior Japan economist Taro Kimura there. We'll also be watching shares of TSMC later, the world's top producer of AI chips, pledging further investment into the US. The CEO, C.C. Wei, joined President Trump at the White House for the announcement.
Today, Taiwan Semiconductor is announcing that they will be investing at least $100 billion in new capital in the United States over the next short period of time to build state-of-the-art semiconductor manufacturing facilities. I think mostly it's going to be in Arizona.
For more, let's bring our tech reporter Annabelle Jewellers. TSMC obviously not alone, but it just adds to more planned investments in the US by TSMC.
Yeah, that's right. And actually, to your point of not alone, I mean, when you think about tech, we've seen Apple, we've seen OpenAI, we've seen Meta pledging more than $1 trillion in total in spending. So yes, TSMC is certainly not alone in this, but it is adding to their existing investments. And Trump made that very clear in the press, as said C.C. Wei, but to say that there's $65 billion that's already been pledged, there's going to be $100 billion in addition to that. So this is really about that push that the US is making to maintain any sort of competitive edge against China in particular in the race to be the #1 in AI. So TSMC, of course, as we know, it's the world's biggest producer of AI chips. Its main customers as well are from the US, so the likes of NVIDIA, also Apple, but bringing more production to the US is a major investment because it builds on what TSMC has already been doing in Trump's first term. When you think about this spending in aggregate, it will bring that presence to 5 plants, so 3 for advanced wafer fabrication and 2 for advanced packaging.
Yeah, I mean, we have seen business leaders as well as governments trying to court President Trump by making these big investment announcements in the U.S. But we're hearing that this still needs to be approved by the government?
Yeah, that's right. So Taiwan's government needs to approve any sort of large overseas investment. But what's so interesting and something that sort of happened a little bit more quietly early this year, it was reported on in local media in Taiwan, essentially to protect Taiwan's local chip industry and the economy and its advanced technology. Taiwan had previously barred semiconductor facilities or companies from shifting the most advanced production abroad. But that changed in January of this year because it meant that the next generation of 2-nanometer production could be done in the US. So TSMC's plants are on track to do this. For instance, the one in Arizona is going to be manufacturing 2-nanometer chips by 2028, others by the end of the decade. But yes, approval is still required for this. Taiwanese officials are saying they're going to be prudently reviewing any sort of outbound investments in advanced chip technology. But at the same time, we know that Taiwan is very keen and eager to prove the value of its relationship to the US. And semiconductors is one of the best ways to do that.
Annabelle Joel there. And some of the other stories, I should say, that we're following when it comes to corporate news this morning. Bloomberg has learnt that Tata Capital is seeking a valuation of as much as $11 billion in what could be India's biggest IPO this year. The company's board last week approved the listing of as many as 230 million shares, along with an offer for the sale of equity by existing shareholders. It also announced a rights issue of as much as $172 million. Chinese electric vehicle maker BYD has raised $5.6 billion in Hong Kong's biggest share sale in nearly 4 years. The price represents a 7.8% discount to Monday's close in Hong Kong and sits in the lower end of the marketed price range. BYD has said that the fresh capital will help expand its overseas business and invest in R&D. Yomiuri is reporting that Seven & I is set to reject a proposed buyout by Alimentation Couche-Tard. Its report says a special committee reviewing the offer decided in favour of keeping the Japanese retail conglomerate independent, apparently out of antitrust concerns in the US. This comes after reports that the board member, Stephen Dacus, is set to replace Ryuichi Isaka as CEO Shery.
And Heidi, take a look at these assets that we're following as we continue to hear news around tariffs and trade. The U.S. expected to impose tariffs on external agricultural products as soon as April 2nd. Of course, they're not very happy with the agriculture trade deficit of the U.S. that rose to a record $49 billion this year. And at the same time, China now considering retaliation on American agriculture and food products. This according to the Global Times. So this really driving up prices of Chinese soy meal used in food and animal feed, as well to the most in more than 3 weeks or so. Right now, we're seeing a little bit of downside pressure, but prices have continued to remain pretty high. Canada also planning to respond with tariffs on $20 billion of goods from the U.S. That could include a lot of food products like wine, coffee, and peanut butter as well, Heidi.
Well, taking a look at OPEC now, Shery, and the unexpected supply hike could be the first in a series of monthly increases to revive production that's been halted for more than 2 years, as bringing our Calgary Bureau Chief Kevin Orland. So this development really caught the market so off guard, particularly in light of the deep scope of uncertainties, both on the supply side and the demand side here.
That's right. The market had widely expected OPEC to put this to push off this production increase again. I mean, the output has been halted for about 2 years at this point, and OPEC has already pushed back this planned increase 3 times previously. And there had been some signals in recent weeks that OPEC was looking at pushing this back again one more time. The backdrop for oil prices right now is not great. Prices have slid a lot in the past couple of weeks, partly driven by that tariff threat and the chance that those may weigh on economic growth and weigh on oil demand around the world. And there's already projections, widespread projections for a surplus of oil this year up to about 450,000 barrels a day later this year, according to the IEA. So the backdrop was already weak, and so I think that's a lot of why this particular move caught the market by surprise today. And as you might be able to see, it ended up with oil prices down about 2% for the day, the lowest prices this year.
Yeah, because just a few weeks ago, we were still expecting them to actually delay this increase, right? So how much is it really to do with President Trump now coming into power and applying the pressure?
Well, that's a great question, and it's really hard to know exactly what OPEC Plus, especially led by the Saudis and Russia, are thinking here. One school of thought is that with Trump in office, he has vowed to sort of return to a maximum pressure campaign on Iran and to try to curtail Iran's crude exports. And so it's possible that OPEC Plus has seen some room maybe to bring some more barrels back into the market from some of the other members to backfill any production that's lost from Iran. But it also could be a sort of offering an olive branch to President Trump. We saw Saudi Arabia a couple of weeks ago say that it was going to invest $600 billion in the U.S. So there could also be some element of OPEC Plus trying to make nice with Trump here. It's hard to know exactly what they're thinking, but it's hard to imagine that the Trump factor wasn't part of this decision.
Bloomberg's Calgary Bureau Chief Kevin Orland there. The Trump factor is sort of permeating almost everything that we're seeing at the moment, including some of these stories that we're following, with President Trump saying that a minerals deal with Ukraine is still possible, despite his recent clash with the Ukrainian president. Trump told reporters that he'll provide more details when he makes an address to Congress on Tuesday. Zelenskiy said earlier that he was willing to meet with Trump again for a serious discussion on the minerals deal and peace plans. The EU is considering helping finance Central East nations to store natural gas in Ukraine next winter. Sources say the bloc could help support some purchases of non-Russian gas by landlocked Slovakia and Hungary, which would be shipped to Ukrainian storage. The fuel would then be sold to countries that used to rely on Russian gas. Australia's east coast is bracing for a tropical cyclone that's currently headed straight for Brisbane, the country's third biggest city. Cyclone Alfred is forecast to make landfall on Thursday or early Friday as a Category 2 storm. Brisbane hasn't felt the effects of a cyclone since 2017, and warnings now extend south into the state of New South Wales, which hasn't issued similar alerts since 1990. More ahead on the Asia trade. This is Bloomberg.
Breaking news at the moment. We're hearing now that the U.S. is pausing all current military aid to Ukraine's defense, according to a defense official right now. Of course, we have seen the disastrous meeting at the White House between Presidents Trump and Zelenskiy. We know that the U.S. support, the existing gear that Ukraine has, could be running out in the summer. And we're now hearing that the U.S. is pausing all current military aid to Ukraine, according to a defense official. And this at a time as we are now seeing that the flow of U.S. weapons to Ukraine have nearly stopped, and that supply could run out around the summer. The Biden administration, of course, saw the $67 billion in military assistance that he provided to Kiev as essential. President Trump right now sees any further aid as leverage. Of course, we continue to watch whether a minerals deal is coming into place with Ukraine, which seem to be contingent on collaboration with Ukraine. And right now we're hearing from a defense official that the U.S. has paused all current military aid to Ukraine. European leaders have gathered in London this week in an emergency security summit to coordinate this defense spending hikes, as they may have to fill the gap left if U.S. support is withdrawn. Britain has called this a coalition of the willing to secure Ukraine. Haidi right now breaking on the terminal, U.S. pausing all current military aid to the country.
that further pressure point, even as, of course, we've heard Zelenskiy saying he's willing to meet with President Trump again after that fiery first meeting in the White House just a few days ago. We're also watching SpaceX at the moment, set to launch its Starship rocket for an 8th test flight from its Starbase facility in South Texas. This was slated for actually just about a minute and a half ago was supposed to be the launch time. We are seeing that the launch clock has been stopped. Apparently, they're saying that there's a vehicle issue, that the launch at the moment is on hold. But this takes place about 6 weeks after the last prototype exploded mid-air. Flight 8 is targeting that liftoff just a couple of minutes ago from the Starbase in Boca Chica near Brownsville, Texas. They have a 60-minute window here beginning at 7:30 a.m. in Hong Kong for this flight test, and we're sort of watching very keenly as to what happens, and I'll bring Paul Allen for more. What's at stake here?
Yeah, just because it's on hold for 40, well, the clock has stopped at 40 seconds.
Yeah.
That doesn't mean it's over for the day. As you say, they can hold here for a little while they iron out any particular problems. So might still be a go. The weather's cleared up. It was pretty foggy a bit earlier on, so there's no reason in that regard not to proceed. And the area is clear both around the launch site and around the Indian Ocean, just off Western Australia, where the upper level, the Starship section, is going to splash down about an hour after launch, if of course it takes place. The objectives here are similar to what happened in Flight 7, which was unsuccessful, partially. They did manage to catch the booster for the second time, but the upper stage disintegrated in midair. There was a propellant leak there, which meant the planned experiments couldn't go ahead. It was meant to deploy some dummy Starlink satellites, so that obviously didn't happen. The plan is to try that again today. And if you study that upper section, the black section, really closely, you can't really see it in that shot, but there are a number of heat shield tiles that have been removed deliberately in strategic locations, and the idea is here to see what sort of stresses the vehicle can withstand when it re-enters the atmosphere. So, you know, this thing's blown up a few times in the past, and every time it happens, it's like, oh, it's a failure for SpaceX and Starship. But that's not really how SpaceX rolls. It expects to fail. It expects things to explode. It's all part of this rapid iteration process. And in the background of that shot, there's an enormous factory just rolling these things out. So even if it doesn't work out today, that doesn't mean it's not full steam ahead down the track.
Bloomberg's Paul Allen, they'll continue to watch that as that is being paused. We're being told that the team is troubleshooting, believe they can resume again soon. Of course, Starship, the most powerful rocket ever built, and really keen to Elon Musk's dream of sending both humans and cargo to deep space destinations like the Moon and Mars. So we'll come back to that as we get a little bit more progress being conveyed to us. More ahead on the Asia trade. This is Bloomberg.
We have breaking news out of Japan. We are getting the latest capital spending numbers, and we are seeing businesses having scaled back capital investments in the final quarter of 2024. We're talking about capital spending year on year contracting 0.2%, which is a big fall from that 8% gain in the previous quarter and below expectations of gains of 5% for the fourth quarter. Of course, this all coming at a time when we're seeing more protectionist trade policies coming from the U.S. administration, tariff threats. So despite the fact that company profits for the fourth quarter were 13.5% acceleration, we are now seeing that scaling back by businesses when it comes to capital investments. Heidi.
Well, Shery, the former Dallas Fed President Robert Kaplan says there's still hope that looming tariffs on Canada and Mexico may not last too long. The Goldman Sachs Vice Chair also told us why both countries are still important parts of a wider U.S. trade strategy.
So there's a little bit of skepticism as to whether ultimately there are going to be tariffs on Mexico and Canada. And the reason for that is logistics and supply chain arrangements with Mexico and Canada are so central to domiciling manufacturing in the United States and global competitiveness. I think there's still a hope that even if they're put on, they won't be on for long, and maybe they'll be threatened and never get put on. I think they feel differently about tariffs on China, maybe relating to Europe, but I think people believe eventually there needs to be a North American strategy for U.S. trade, and that means Mexico and Canada are very central to that North American strategy.
So do you think that CEOs are changing their businesses right now, planning? You know, what are you hearing in that realm?
I'd say they are pausing and trying not to overreact, but are being prepared that they may have to make substantial changes. I don't think we're to the point where they're jumping at some of these potential tariffs or threats, particularly again on Mexico and Canada, but they're getting prepared to make alternative plans. The concern is it will raise costs and it may undermine their competitiveness globally. And those are things that I think are probably you'd prefer not to have.
How do you think the Fed should respond? And are there any long-term concerns for the economy?
So the Fed will be more likely to look at the whole puzzle, not just one action. So government spending cuts, changes to immigration, changes to energy ecosystem, changes to regulation, and then tariffs are part of that puzzle. And what you're seeing in the economy is it appears to be a slowing of GDP growth. We'll know better as the weeks go on. So probably somewhat slower growth and prices staying sticky. So I think the Fed, at least in this upcoming meeting, is most likely to do nothing. And they're going to take it one meeting at a time and try to assess these changes.
Goldman Sachs Vice Chair Robert Kaplan speaking with our colleague Julie Fine. Take a look at how oil prices are trading at the moment in the Asia session after falling to this year's low. Of course, we have seen now the surprise move by OPEC Plus to increase oil production by 138,000 barrels a day starting in April. They plan to restore 2.2 million barrels a day by 2026, all at a time when we continue to watch geopolitical tensions surrounding Russia, surrounding Ukraine. We are now hearing that the U.S. is pausing all current military aid to Ukraine. This is according to a senior defense official. Of course, Haidi, we have seen the Biden administration giving $67 billion in military assistance to Kiev, but the existing U.S. gear could start running out in the summer.
Shery, we're going to get back to SpaceX. It looks like no launch today. SpaceX announcing that they're standing down from the Starship rocket test flight today. Of course, there was a pause. The launch countdown restarted and then it was paused again, and it is not going to go ahead today. This, of course, was going to be the 8th test when it comes to the Starship. The previous one, the 7th test, ended when it broke apart, and it was very quick turnaround being seen for SpaceX after that last attempt ended with that explosion less than 2 months ago. So that launch from the Starbase facility in Texas is not going ahead today. We'll wait to see if there's further developments in terms of a rescheduling. The market opens in Seoul and Tokyo are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens, embracing for President Trump's tariffs on Canada, Mexico, and China to take effect in the next few hours. The most sweeping of the Trump era, applying to around $1.5 trillion of goods, Haidi.
Yeah, Shery, brace position is a good way to put it in terms of how investors and markets must be feeling at the moment. It's quite interesting that it seems like with that overnight session, particularly consolidated by the fact that we had the poor US eco data as well, it feels like this is a market that, you know, has really sprung from complacency or hope that these tariffs will kind of be able to be worked out or come to a compromise. And now really the reality is starting to hit.
Yeah, we saw that worst sell-off of the year for Wall Street, with the S&P 500 now down about 5% since its February record high. And you can see right now the Nikkei trading to the downside at the open, 0.7%. The Japanese yen also stronger overnight as we saw that safe haven demand at around that 149 level. Also, we have idiosyncratic data here in Japan as well. Fourth quarter capital spending contracting instead of expanding, which was expected by economists. Really, business is scaling back those investments in the final quarter of 2024, given these concerns around trade, around tariffs as well. The jobless rate, though, 2.5%, very tight labor market. And take a look at the Kospi coming back from a holiday. We had seen the Korean won already at that 1-month low against the U.S. dollar. We saw industrial output data this morning contracting more than expected as well, more than 4% for South Korea. Of course, we continue to see that economic pressure in South Korea, given that this is a market very heavily exposed to tariffs, to exports, especially when it comes to semiconductors, car makers as well, Haidi.
Yeah, take a look at what we're seeing when it comes to Australia. Of course, that sort of exposure when it comes to it trading as a China proxy, and of course, there's additional pressure coming down on China expected to weigh as well. We are seeing downside there, ASX 200 off by just over 1% at the moment. In terms of that sector breakdown, we are seeing really broad losses, just a couple of subsectors trading in the green at the moment, but the steepest losses being seen across energy, some of the oil names down by 2.4%, utilities also off by close to 3%, tech, as well as some of the materials, miners and financials, as well as property, all shedding over 1% at this point in the session. We are seeing the Aussie dollar seeing a little bit of weakness there. Of course, this is really one that trades as that China proxy there as well, right? As we kind of just get that broad trade uncertainty. We also have the CPPCC as well as the MPC kicking off in Beijing this week, and some of that policy uncertainty there as well. But really looking at bond yields as well, jumping as this defence promises really ripple out across the world, and so much of the broader kind of trade and economy sort of uncertainty playing out. We saw Treasury yields falling to really multi-month lows with that US growth story and resilience, right, Shery, kind of in doubt now.
Yeah, despite all of these risks, our next guest now saying that he remains constructive on Asia's 3 largest economies. Let's bring in Vikas Pershad, Asian Equities Portfolio Manager at M&G Investments. Vikas, always good to have you with us. So give us your reaction to the market moves today. Is this just a blip given that the tariffs are expected to go into effect? I mean, the rallies and the continued strength of the U.S. economy, U.S. markets has been pretty unstoppable.
Hi, good morning, Shery. Yes. Is it a blip? It's hard to say. But when you look at the valuations in the U.S., in the last couple of years, looking over longer time horizons, we're quite stretched, and especially so in the tech sector. And so I would not be surprised if the sell-off in the U.S. continues. There's still a lot of noise. Valuations are stretched. Earnings expectations are very, very high. We saw what happened to NVIDIA stock post-reporting. And that's consistent across the Mag 7 and other large leading tech companies in the U.S. When we turn our eyes to Asia, however, what we see is a very large expanding opportunity set across North Asia and South Asia, and the dislocations that we're seeing set things up well for genuine long-term investors. Our view is that these kinds of markets will highlight the difference between those who are traders in the short to intermediate term and those who are genuinely long-term investors, and for the latter, there are plenty of opportunities all across Asia.
Is that why you like China?
We like China and Japan and India for the medium to long term for different reasons. The high growth in India, yes, earnings expectations have been reset. The corporate governance transformation underway in Japan, which is nowhere near done. And in China, just the long-term dislocation from intrinsic value. Starting in the second half of 2023, this is one market where we have been consistently allocating more capital. This is China I'm talking about. And we see opportunities across sectors. Even in what is optically a weak economy for investors, it's a matter of public record that we were one of the 5 cornerstones in a big IPO that happened yesterday. And we continue to see opportunities like that across China, across market caps. And these companies are increasingly going global, which is a new angle that we came upon, I'll say, a year and a half, 2 years ago. So that's something we're very excited about as well.
Of course, the sort of one story in town at the moment is really looking at these tariff risks, right? If you take a look at what we're seeing at the moment, and I guess insofar as a certainty we have on the category and scope of these tariffs and where they're directed, where do you see the vulnerabilities? Which assets will suffer the most from Trump's tariffs? That's our MLive question of the day.
So in our view, there are 2 sectors that are clearly impacted. One is the tech hardware sector, semiconductors, and Singapore's been in the news in the past few days. And then also in the auto parts supply chains as well. our view is that across the region, but especially in Japan and India, these auto companies, auto parts companies, have already largely begun to reflect and incorporate the risks into their share prices. So we do see some opportunities there. And in China, and companies that are operating in China, the tech hardware sector, they probably still are more vulnerable than the auto sector companies are, given where valuations still are, and given the widening of the ranges for earnings outcomes there for the next couple of years. So it's not done yet, but prices have already adjusted quite a bit, especially in the auto parts and auto OEM spaces in Asia.
You've said you're already constructive on Chinese equities, and it's, what I'm getting is that it's sort of more of a medium-term, long-term play. What are you expecting to see or hoping to see from the MPC and the two sessions over the next week or so? And is there anything that would really change your position depending on what policy announcements or support get announced?
So on the latter, unlikely. Our view is constructive on China for the long term. And then on the former, thinking about what are we expecting. If we go back to September, the excitement around the stimulus, that did not really change or accelerate our allocation of capital to China. And if you look back over the last couple of years, we have remained constructive on China for a lot of the reasons that we've talked about in the past. Number one, the government clearly is aware that pain needs to be taken in the real estate sector. That has come. And the pace of change there has been necessary. Now, on the consumer side of things, we remain very constructive across various sectors. Whether the stimulus is X dollars or 1.5X means less on our time horizon than it might to participants who are looking for shorter term returns. But in China, the opportunity set is larger, and it's getting larger every year.
Because when it comes to Japan, what's your base case for the yen in your constructive view, and does it add more layers to what sectors you prefer?
Yeah, so in Japan, what we see is a market that is capable of delivering low teens returns over the next few years, compounding at that rate. 8 to 10% of that is earnings growth, and that's where we sensitize various company earnings scenarios to the yen. I think here it's not going to make too much of a difference to what we've prepared for. A material strengthening from here or a material weakening from here would cause us to reevaluate that. But somewhere between a 140 to 160 range, we feel like that's what we are prepared for. That's what equities are pricing in now. But when you look at that mid-teens or low-teens return that's possible for Japan, only 8 to 10% of that is coming from earnings, which is also healthy. But there's dividends, there's share buybacks, there's increasing dividends as well, and that takes you well past 10%, we think. So Japan is a earnings growth story, but it's a corporate governance transformation story also that is still, at best, in its middle innings. This is going to last for a while.
Vikas Pershad, Asian Equities Portfolio Manager at M&G Investments. Good to have you with us. Let's stay in Japan because we're seeing some big moves. There's really a lot to the downside, especially when it comes to semiconductors, automakers that will be affected by President Trump's tariffs. But this is one stock that we're watching very closely, 7 & I Holdings at the lowest level since August. We have heard from local media, Yomiuri, saying that 7 & I will be rejecting Couche-Tard's buyout offer. 7 & I is reportedly also appointing board member Stephen Darkis as CEO to replace their current CEO, and this, of course, in a move to prevent that takeover by Canada's Alimentation Couche-Tard. And now local media saying that they will be, in fact, rejecting that buyout offer. Heidi.
We'll be watching that, the further developments there for 7 & I. But Shery, still ahead, Colonial First State Superannuation CEO Kelly Power joining us to tell us why Australian pension funds are looking to boost investments in the US. But first, we'll be live to Beijing with China's top political meeting set to begin just as President Trump doubles down on tariffs. This is Bloomberg.
A senior U.S. defense official has told Bloomberg that President Trump has ordered a pause to all military aid to Ukraine. This comes just days after an Oval Office blow-up with the Ukrainian President Volodymyr Zelenskiy. News desk editor Jill Deacies has more on this, and this is, of course, something that Bloomberg has learned just now. How significant would this be for Ukraine?
Well, this is a pretty significant escalation that we're talking about. So effectively, what we've been told is that the U.S. is pausing all current military aid to Ukraine until Trump determines that Zelenskiy, the country's leaders, have really demonstrated a good faith commitment toward developing peace here. So this seems to apply to pretty much all military equipment that is not currently in Ukraine. That would include weapons in transit or awaiting in transit in areas in Poland, for example. We'll remind you that Trump really came into office with somewhere in the neighborhood of about $3.85 billion remaining in funding from the previous administration to use, toward these, types of support efforts. So it's really kind of unclear how much is ultimately, in effect here, or how much is affected here. But that does give you kind of the scale here. And I think the other thing, too, that's really important to point out here is that it kind of points to how much pressure Trump is really trying to put on Zelenskiy. I mean, we all witnessed that meeting, incredibly tense meeting in the Oval Office late last week. We've seen, Zelenskiy now kind of turn to European leaders, trying to get them to work with him. But at the center of all of this, the U.S. does remain a really, really critical partner in negotiations here, as they try to work toward a peace deal in this war. So we'll have to see ultimately how, this latest sort of pressure campaign from the Trump administration, feeds into what's developing here.
Of course, the other pressure campaign has been tariffs, right? Mexico, Canada doubling down when it comes to China. What are we expecting? And President Trump is sort of talking tough, saying that time has run out for negotiations, but there is sort of always room for a deal at some point.
Yes, I mean, I think that the one thing that you really do have to keep in mind with any of these tariffs, obviously, at this point, we are expecting, once, we sort of hit midnight in the U.S. here for these 25% tariffs on Canada and Mexico to go into effect, 10% on Canadian energy, also that additional 10% tariff on China, although we do know that, the Trump administration so far has been kind of no stranger to sort of last-minute deals or, sort of doubling back on certain things. We saw that happen with tariffs that were threatened on Colombia just earlier this year. But at this point, I mean, Trump seems to be making pretty clear that he expects these tariffs to go into effect. I think at this point now it's waiting to see whether that actually does happen, and then also waiting to see what kind of, sort of reciprocal efforts we might see, whether that be from Canada, Mexico, maybe even from China. So we have, heard that, potentially China could consider, some kind of a tariff on agricultural imports. But at this point, again, kind of unclear here. So far, China in particular has been pretty measured with the types of responses they've made to previous tariffs from the Trump administration. So we'll see if there's any kind of a meaningful escalation there.
Bloomberg News desk editor Jill Deacies there. And Trump's doubling of tariffs on China comes at a time as the country's top political advisory body begins its week-long gathering in Beijing. Bloomberg's chief North Asia correspondent Stephen Engel joins us live now from outside the Forbidden City. And of course, it is two sessions season, right? And there's a lot on the agenda, and it's not just about China's domestic challenges.
Yeah, that's right. But domestic challenges, I might remind you, are top front and center for those delegates that will be gathering here over the next week or so. We don't have the end date exactly yet, but it should last about a week based on last year's session. We have the CPPCC, which is the big advisory body, several thousand delegates from the Communist Party as well as non-Communist Party entities in the economy. They'll be gathering this afternoon at the Great Hall of the People ahead of the beginning of the National People's Congress, the annual session of Parliament beginning tomorrow morning, where Li Qiang will be giving his annual work report, where we're expected to get a fairly optimistic same GDP growth target of around 5% that we got last year, because again, we're expecting, the market's been expecting for months now, details of of a larger stimulus package, including essentially raising that fiscal deficit or the budget deficit target from 3% upwards as high as possibly 4%. Some say around 3.8%. Still, it would be the highest target for the budget deficit in 3 decades. So they do have to pump trillions of yuan, many economists say, into this economy to kind of weather the slowdown in this economy that is exacerbated, no doubt, by the escalating Trump trade war and those added doubling of tariffs to 20%. It might not be front and center of the communication coming out of the MPC, tariffs I mean, but it will be on most people's mind, how to weather the storm when exports have really allowed the Chinese economy to weather the downturns, obviously, in consumer spending, retail sales, and of course the property sector, which is still trying to put a floor on that years-long crackdown. So lots to discuss over the next few days, especially tomorrow when Li Qiang takes the podium and delivers that work report. Essentially, it's the marching orders for the provinces and what they have to deliver.
Steve, when it comes to President Trump's tariffs that you mentioned, of course, how important is it for China to have a really restrained but perhaps calculated response given all of the economic risks that you've laid out?
Well, we'll have to see how restrained they're going to be this time. 3 weeks or so ago, about a month ago, when Trump announced, of course, that first round, the opening salvo of 10% tariffs on China in response to what he said was a lack of response on the fentanyl issue. The response from China was fairly muted, as Jill Deeses had just mentioned. They put tariffs on about 80 U.S. products, but not the high-volume products that we saw in the first Trump trade war in his first term, where soybeans were targeted, and soybean exports from the United States to China dropped about 80% over the 2 years after those retaliatory steps from China were put into place. Also, just a few weeks ago, they did some export controls on tungsten-related minerals. There's still more room on rare earths that the Chinese could do. They could definitely go down the road of soybeans and other agricultural products that the United States ships to China, including corn and wheat. So there are steps, and we got essentially a report yesterday from the Global Times, the state-run media newspaper, essentially saying that China is preparing. They quoted unnamed sources, but again, it's coming from state media, so it's a way for the Beijing leadership to telegraph their moves, that they're readying some fairly forceful moves to counter this escalation from 10% tariffs to 20% that Trump has just signed today.
Our Chief North Asia correspondent Stephen Angle there in Beijing for us. Take a look at what we're watching when it comes to European futures. That session just opening up at the moment and taking that negative lead from Wall Street, from the Asian session at the moment. Euro Stoxx 50 futures off by just about 0.5%. A little bit downwards when it comes to German DAX futures as well. This comes after a pretty significant session, though. We had stock benchmarks for Europe hitting record highs. Regional leaders pledging to boost military spending, so that defence play really helping send stocks to fresh records. Defence stocks in particular adding $35 billion in market cap, so that's really where we've seen the very sharp rally. We've seen some companies in particular gaining over 90% so far this year, and there is further expected momentum when it comes to defence stocks there, with public defence spending really expected to rise sharply, even if that sort of peace process for Ukraine does come to some sort of resolution for 2025. We are also watching the euro as well. The euro advancing about 1% against the greenback in the previous session, again on these prospects of a lift for the region's economy on the back of sort of stronger defence mechanisms for Europe. Shery.
And momentum to the downside when it comes to Asian currencies, Haidi, because we continue to see the Thai baht, the Korean won under pressure. These currencies have already lost about 2% over the past week. Of course, we have fears over a global trade war. And of course, Asian central banks also cutting interest rates to support growth. So you can see the Bloomberg Asia Dollar Index now on a downtrend after a little bit of a rebound that we saw in January. For more, let's bring in Bloomberg Executive Editor for Asian Markets, Paul Dobson. Paul, good to have you with us. at a time when President Trump also talked about the Chinese yuan, the Japanese yen, weakening that trend, and that weaker currencies are actually an unfair disadvantage to the U.S. But I mean, how inevitable is this given the macroeconomic fundamentals, and then you have all of these tensions around trade?
Yeah, morning, Shery. I think this is going to be absolutely crucial in the way that the trade and tariff deliberations are expressed in financial markets in the coming weeks. Keep an eye on the Chinese yuan. All important. The Chinese response last time around when Trump was putting tariffs, when he was enacting the trade war, was to allow the yuan to weaken in order to offset some of the hurt for its companies that the tariffs on the U.S. imports was having. So Trump seems like he's trying to get ahead of that a little bit with these sorts of comments, talking about how allowing a weaker yuan or encouraging a weaker yuan would be an unfair advantage against the U.S. and, presumably therefore a red line for him or an excuse to ratchet tariffs even higher. On the other hand, we haven't seen very much sign of it at all yet. In fact, a lot of analysts had forecasts for a much weaker yuan this year, way back in December and January when we were looking forwards to it, expecting exactly that kind of response. And yet so far, China has really held the line, kept the currency very well behaved and well ordered around the fix. No real signs of weakness. And we saw in the last few days some of those strategists starting to pull back their forecast for how much weakness we would have as a result. That's really important because it anchors currencies for the rest of the region as well.
Paul, when it comes to obviously the decline that we saw on Wall Street overnight, it wasn't just the tariffs, but also the weak ISM data as well, right? Do we feel like with this reality check for investors on tariffs, is the sort of US exceptionalism story looking a bit wobbly?
Definitely, that's the way that the narrative has gone in the past few weeks in financial markets. We went from this versatile expectation that Trump's tariffs are going to be very good for the economy. They're going to push forwards growth. The tariffs, okay, they have some downsides, but on the other hand, they should boost home production and maybe raise inflation, which perhaps will be better news for equities than it will for bonds. That narrative seems to have flipped on its head. Now people are worried that Trump is going to do some harm to the economy, at least in the first half of his stay in office, maybe getting that bad news out of the way first of all. But that's driven a lot of cash back out of US equities, a lot of underperformance there. And it is weakening the dollar, and it is undermining the dollar to a certain extent as well. We're seeing lower treasury yields, people bringing back in bets that the Fed will have to cut interest rates again sooner. And so that has undercut the dollar. And as one thing that's a good news for Asian currencies that are under pressure as well.
Bloomberg Executive Editor for Asian Markets, Paul Dobson there. Much more ahead on the Asia trade. This is Bloomberg. Taking a look at benchmarks across the region, we are seeing broad declines there after these tariffs sparked the rout in the US. We are seeing the Kospi breaking apart, though, seeing a gain of 0.6%. We are getting some breaking news when it comes to what we're seeing from Goldman Sachs at the moment, with David Solomon speaking at an event here in Sydney, talking about how the Chinese economy faces significant headwinds. There's uncertainty over how Trump addresses the trade imbalance, and that the pendulum swing from heavy regulation to unlock growth as well. So that's what we're hearing. We're also getting breaking news when it comes to the RBA as well. The minutes of that February policy meeting where, of course, they moved to cut rates. They expressed caution about prospects of further easing. Of course, Governor Michelle Bullock really tried to talk down the prospects of this being a deep or significant easing cycle, given a lot of the extra fiscal spending and a lot of the trade uncertainties that are expected to impact Australia's economy. The future decisions will be guided by data and an assessment of risks, and that returning inflation to the target remains the highest priority, saying that the strongest reason for the cut was a signal from CPI as well as wage trends, which could mean more job capacity initially then thought. She also talks about the uncertainty when it comes to US and Trump policy, right, saying that US uncertainty could impact spending by firms, by households as well. They're mindful of keeping the policy tight for too long. And Shery, that was one of the things that the Deputy Governor, Andrew Houser, spoke to us about the modelling that saw that if they didn't cut in the previous decision, that there was a chance that the CPI was actually going to overshoot that target.
Yeah, as we're digesting that Australian data, January retail sales rising 0.3% month on month, coming in line with expectations. Fourth quarter current account deficit also at that 12.5 billion Aussie dollars. As we're also getting eco data out of South Korea, we are getting the manufacturing PMI numbers 49.9, just below that threshold of expansion. It's been fluctuating around those lines for South Korea as we continue to digest the industrial production numbers that we got for the month of January as well, with a bigger contraction for South Korea than was expected. Really a lot to do, of course, with what's happening on the front loading of a lot of this manufacturing because of potential tariffs and, of course, everything that's happening around the growth of the global economy. We're also following what's happening in the chip sector. Take a look at the semiconductor-related stocks across Asia. Of course, we have seen those tariffs to be implemented this week on Canada, Mexico, and China, but at the same time, there are more potential tariffs to come. April 2nd could be the time when we get sectoral tariffs on chips, pharmaceuticals, also automakers. So we're seeing the likes of, for example, SoftBank now falling as much as around 6% at one point, the most since mid-February. Of course, we had the overnight session as well. ARM Holdings closing down about 8% in New York. And you can see the downside across the board around Asian chip names. We'll also be watching shares of TSMC later after the world's top producer of AI chips pledged further investment into the U.S. CEO CCO joined President Trump at the White House for the announcement.
Today, Taiwan Semiconductor is announcing that they will be investing at least $100 billion in new capital in the United States over the next short period of time to build state-of-the-art semiconductor manufacturing facilities. I think mostly it's going to be in Arizona.
For more, our tech reporter Annabelle Drewler joins us. Belle, so this spending adding to other planned by TSMC in the U.S.?
Yeah, that's right. So they've already committed $65 billion to date, but President Trump and also CCO made it very clear in that presser that this $100 billion is going to be in addition to that. So it's clearly an investment that President Trump wants to see. We know he's made this very big push to ensure or at least try and make the US the #1 destination in the world for AI. It's a very intense competition between China. But the point is for today, TSMC, the world's biggest producer of AI chips, also its biggest customers, they are in the US, the likes of NVIDIA, Apple, of course. So bringing production to the US is a major investment, but it already builds on what TSMC is doing in the States. So in total, that presence now is going to be at 5 plants. Well, that's what's in the pipeline, but 3 for advanced wafer fabrication, 2 for advanced packaging.
What's been the reaction from analysts so far?
Yeah, we actually had some commentary out from our Bloomberg intelligence team, and I guess the sort of initial thought could be, what does this mean for margins and operating profit for the business? Because, of course, manufacturing in the US is significantly more expensive. But their view is actually over the longer term, this just continues to help TSMC essentially lock out any sort of threat from Intel that we know is also making a play into the foundry business. So they're saying that, yes, there could be some implied reduced profitability, but still when you've got this much production coming in the pipeline, it does mean that TSMC is going to be in a position to fully capture the demand from NVIDIA, Apple, other key customers in the US as well. So TSMC, I mean, it's really been under pressure from the US administration going back to Trump's first term in office to shift more of its advanced capabilities to the States. And so this is also part of that effort from Taiwan to continue to prove its value strategically to the Trump administration.
Right, Annabelle Drewler's there with the latest on TSMC and, of course, the chip sector. As we're also watching another sector, that's automakers, and you can see red across the board. Of course, we are expecting those tariffs today when it comes to Mexico, Canada, China as well. We know that many of these names in Japan, also in South Korea, are very much exposed to whether it's sales in the U.S. or sales to China as well, especially the likes of Hyundai, Kia. And not to mention that we could see potentially more sectoral tariffs on cars as well starting April 2nd, according to some of those threats by President Trump. Heidi.
Taking a look, Shery, at some of the other corporate stories that we're watching, the Chinese electric vehicle maker BYD has raised $5.6 billion in Hong Kong's biggest share sale in nearly 4 years. The price represents a 7.8% discount to Monday's close and sits in the lower end of the marketed price range. BYD has said the fresh capital will help expand its overseas business and invest in R&D. Yomiuri is reporting that Seven & I is set to reject a proposed buyout by Alimentation Couche-Tard. Its report says a special committee reviewing the offer decided in favour of keeping the Japanese retail conglomerate independent, apparently out of antitrust concerns in the US. This comes after reports that board member Stephen Dacus is set to replace Ryuichi Isaka as CEO. We are going to head back to what we're hearing when it comes to the event here in Sydney, where David Solomon from Goldman Sachs has been speaking. He's been now talking about the growth potential when it comes to AI. He says he's a huge bull on AI over the next 5 years. We had heard previously he'd spoken about his views on the Chinese economy as well as the US economy, the uncertainty over how Trump addresses trade imbalances, and that China faces significant headwinds with its economy as well. Also speaking about how fiscal spending has been a tailwind for the US economy, but that there is a very small chance of a US recession. The Goldman Sachs CEO David Solomon there speaking at a summit in Sydney, and this comes, of course, as we continue to see the clock tick down when it comes to the tariff orders on Mexico and Canada, as well as new double tariffs when it comes to China as well. The tariffs are kicking off on Tuesday for Canada and Mexico to apply to around $1.5 trillion in annual imports at 25% on all imports from Canada and Mexico, except for Canadian energy at a 10% rate as well. So we'll be watching for that, of course, as David Solomon really comments on the policy uncertainty that's facing the US economy right now. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching. We're just almost 2 hours into the start of trading this morning here in Sydney. We're seeing some downside, really tracking the broad risk-off sentiment across the rest of the region as markets and investors bracing for the rollout of more trade tariffs from President Trump. We are seeing the ASX 200 really being led lower by some of the utilities, the miners, property, pretty broad-based sell-off that we're seeing at the moment. When it comes to the policy side, we also had the RBA's February meeting minutes. Of course, this when they cut rates for the first time in 4 years, really expressing caution and saying that the board is not committed to further policy easing. So really in line with what we've heard from board members, from Governor Bullock, in terms of this could be potentially quite a shallow and an unusual sort of easing cycle. The Aussie dollar is holding at 62.13. We're perhaps seeing some of that sort of proxy risk from those double down China tariffs as well. Australian pension funds are looking to boost their investments in the US. Superannuation executives met with the Trump administration and their officials last week to discuss investment opportunities. About $400 billion of super fund capital was invested in the United States. That's expected to exceed $1 trillion by 2035. Australia has the fourth largest retirement savings pool globally, but it touts itself as the fastest growing. It's expected to become the second biggest in the world by 2030. Well, Kelly Power, who's the CEO of Superannuation at Colonial First State, joins us now. Kelly, really great to have you with us. And I mean, in a way, it's a great problem to have, to kind of work out what to do with this growing pile of investment cash. Why to the US is there so much interest right now?
Oh, look, I think it's patient capital, it's long-term capital. We're a very sophisticated market from an investment perspective, and yeah, like it's sort of an open door when you go to the US in terms of people looking for investment opportunities. In our fund, it's about $8 billion invested with the US, and we're increasing that all the time through our partnerships and moving into new asset classes as well.
There's a lot of sort of anxiety in terms of how that money is deployed, right? Are you sort of constantly looking at new products and offerings?
Yeah, look, so obviously equities is a big portion of it. 75% of global equities sits in the US, so it's a big part of our allocation. But we are increasingly looking at infrastructure, we're looking at private equity and other asset classes, and really just responding to opportunities to get the best outcome for our members.
What sort of investments abroad are you looking at? Are there sort of specific sectors, and how, I guess, complex is that navigating that landscape given the policy outlook is so uncertain right now?
For us, we are a small investments team, about 30 people, and so we really just respond to whatever opportunities are available. So there's no real geographic tint. There's a lot of money going into unlisted assets. That's not, not just a US theme, that's globally. A lot going into private equity, a lot going into private credit, and a lot going into infrastructure. So we're looking at all those opportunities, but for us, we really look through partnerships. So we have a partnership with BlackRock, for example, and we look for local teams that are onshore to help us deploy the capital.
Private credit is a really interesting one, and we spoke to actually ASIC just a few days ago. There are obviously concerns over sort of transparency and the regulations side. How compelling is it for you as an asset class?
I think it's important from a diversification and return perspective, and for us looking at making sure that we're not concentrated with too many partners, making sure that we don't have concentration around too many specific types of loans or investments is important. From ASIC's perspective, they're looking more sort of systemically at the whole system. I think their report did say that it's not a concern at the moment, but obviously it's a growing asset class. So we're making sure that we've got the right partners with the right track record in this space.
Is private market reporting something that you think will reform or change?
Based on what I saw in the report, I would suspect that there will be more change around that, but I don't necessarily think it's an issue at the moment.
We're talking a little bit about sort of attitudes around retirement and anxiety, particularly amidst, still high inflation and a cost of living crisis. What are the main themes that you kind of see when you speak to people about, what happens down the track?
Yeah, we recently did a survey actually, and cost of living was the greatest concern for Australians, no surprise there. But what we did see in our report was that the majority of people that are moving into retirement, it's something like 60%, don't feel comfortable about the retirement that they're going to have. And about a quarter of them in retirement are still paying debt, so using their pension payments to pay debt. So it has to be a big focus for us as superannuation funds and the government in terms of providing advice to those individuals. Retirement is really hard to navigate. It's very complex. No two retirees are the same. So having support, guidance, help, really important.
What would you like to see from the government? Obviously, election year, and we're expecting that to be announced really sort of imminently. Are there policy settings from that level that you think could help?
Absolutely. So the Quality of Advice Review report, we're still waiting to see the Tranche 2 reforms come out. And so that Tranche 2 piece is really the one that will deal with this advice accessibility issue. So the average cost of advice now is about $5,000. I think the average you need to have is about $1 million. And we know from our membership that the people that need advice the most are those 200, 300,000 where you can optimise your age pension. So that problem has to be solved. We need to get more help to those people. And that really is contained in that Quality of Advice Tranche 2 reform.
There's so many sort of unprecedented risks and unknowns at the moment, from a political, geopolitical, trade front, right? Do you have a strategy and plan in terms of navigating volatility in global markets, or is it something that you kind of have to take step by step?
Look, this is, not our first rodeo with volatility, so we know how to sort of face into that. This super is a long-term investment for most people, but it doesn't mean that, in particular, our retirees don't have concerns and questions, aren't likely to ring us and say, well, should I switch to cash, for example? So we have good processes for helping people through that and ensuring that they don't react to, uncertainty or small sort of components of volatility. And so we support our members with, communication, education, and have guidance teams that help with that too.
Kelly, really great to have you with us. Kelly Power, who's the CEO at Superannuation at Colonial First State. And we do have much more on Australia Ahead every Tuesday. That's 11:40 a.m. if you're watching in Sydney, 8:40 a.m. if you're catching us from Hong Kong. You can also tune into our Bloomberg Australia podcast, delving into the biggest stories that shape the country's role in global business. That's on Apple, Spotify, or you can find it at Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg. We are just getting breaking news, of course, as we await these Trump tariffs to take effect when it comes to Canada, Mexico and China. We are getting that response from the Ministry of Commerce in Beijing. The statement on US tariffs saying, unsurprisingly, strong opposition. They strongly oppose US tariff measures. They hope that the United States will handle the issue objectively and rationally. They're calling on the US to return to dialogue to resolve this and urging the US to respect the rights and interests of other countries, saying that the US cannot solve these tariff moves cannot solve its own problems, and also calling on the United States to withdraw these unilateral tariff measures, really reiterating that countermeasures will be used when it comes to their response to US tariffs, as well as saying that the necessary measures will be taken to defend their interests. And of course, this, as we have heard, some reporting domestically when it comes to op-eds within China, saying that there are measures, both tariff and counter tariffs, as well as non-tariff measures that can be taken. This after Donald Trump on Monday signed an order to raise US tariffs on China from 10% to 20%. This all happening, of course, right before the annual National People's Congress gets underway on March 5th in Beijing. And Chinese leaders expected to stay the course there when it comes to not giving in to US pressure or rushing towards sharing any kind of massive stimulus to counter the expected extra pressure from US tariffs. But we are getting, I think an expected response from Beijing in terms of urging dialogue, but also reiterating that they will take necessary measures to defend Chinese interests.
Yeah, that op-ed you mentioned coming from the Global Times in China, saying that Beijing is considering retaliation on American agriculture and food products in response to these tariffs. So we saw really the market reaction already. Soy meal prices, for example, hitting the highest level in weeks. And these components, of course, used in food and animal feed as well. And you said it, President Trump doubling down on those tariffs on China, actually doubling the tariff rate to 20%, signing an order saying that Beijing had not taken adequate steps when it comes to addressing the flow of illicit fentanyl into the U.S. And the issue right now, of course, Heidi, is that it's not just tariffs on Canada, Mexico and China, but also we could see reciprocal tariffs on all countries, really taking into account not only tariff barriers, but non-tariff barriers. We're also talking about steel and aluminum tariffs to come into place around the middle of March. So we'll continue to watch all of these tariff developments around the world and what that means for the broader markets. And of course, we continue to watch India as well. Bloomberg has learned that India's Tata Capital is seeking a valuation of as much as $11 billion in what could be the country's biggest IPO this year. Bloomberg's Avril Hong joins us from Singapore. Avril, we've been hearing rumors and speculation about this deal. What do we know?
Indeed, Shery. I mean, last week we saw how the board approved Tata Capital's IPO plans to sell 230 million shares, as well as to tack on a rights issue offering for existing shareholders. And at the time, the reporting suggested that they were looking to raise about $1.7 billion, which would already have eclipsed the $1.5 billion that the local unit of LG Electronics was said to have been looking to raise. But now sources are telling Bloomberg that Tata Capital is seeking to raise as much as $2 billion. So this could put it on track to becoming India's biggest IPO this year. Of course, sources have also said that these discussions are ongoing. Details could change. For context, Tata Capital is a financial services unit of Tata Group. It's a non-bank financial institution, so a shadow lender, and its business includes loans to customers who have limited access or typically no access to traditional banking, and it manages about 1.5 trillion rupees worth of that. And it's really this trend we're seeing in India, where the IPO market continues at this clip despite the slump in the stock market.
And Bloomberg's reporter Avril Hong there with the latest on Tata Capital. This, as we're getting breaking news as well, another deal perhaps taking place. According to the Wall Street Journal, Walgreens now closing in on a deal with private equity firm Sycamore that would take the drugstore chain off the public market for around $10 billion. This, according to people familiar with the matter, speaking to the Wall Street Journal, that the sides are aiming to complete a deal as soon as Thursday. They have been discussing Sycamore paying somewhere around $11.30 a share to $11.40 a share in cash. The deal could also include contingent value rights that would increase the value if certain targets are later reached. This according to the Wall Street Journal. So we'll continue to watch whether Walgreens is really nearing that $10 billion deal to go private, Haidi.
Yeah, and of course we continue to watch to see how we see that market reaction, particularly when Greater China stocks come online, right? We have just had that response from the Ministry of Commerce when it comes to this doubling down of Trump's trade tariffs on China from 10 to 20%. And this is what we're seeing when it comes to that response there. For the statement didn't really kind of disclose further actions on U.S. tariffs, but certainly said that necessary countermeasures to defend Chinese interests would be vowed, reiterating that countermeasures against U.S. tariffs are really something that Beijing is looking at, but calling on the U.S. to withdraw these unilateral tariff measures, saying that these moves cannot solve the United States' own problems, urging the U.S. to respect the rights and interests of other countries, and saying that they're strongly opposed to these tariff measures. They're also calling for a return to dialogue, which is quite interesting as well, saying that this issue needs to be handled objectively and rationally. We've also heard, according to local reporting, that they're considering some of these retaliatory measures on U.S. agri-food products, as well as we continue to count down to really the kicking off of this escalating trade war. This is Bloomberg.